Hi there, I'm Mark Anderson. I'm a mortgage banker with Paramount Bank, and I'm licensed to lend in all 50 states. So no matter where you are, if you would like a clear, informative, direct, non-salesy purchase mortgage consultation, or maybe you want to kick the tires on a refinance scenario to see if that makes sense for you, please don't hesitate. Call or text me at the number below anytime, and I would be glad to help out. So what I'm doing today is continuing my series called The Chickens Will Come Home to Roost. So if you didn't catch my last video in this series, you may wonder, what in the world do chickens have to do with mortgages and home prices? Well, I'm making maybe a little bit of a silly comparison, but I like it and I'm going to stick to it. I'm making a comparison between the natural instinct that chickens have to roost at night when it gets dark, making a comparison between that natural phenomenon and the natural push and pull forces that operate within the economy. I think it's very important to keep in mind that there is a reason that economists, by and large, are not automatic millionaires. Economics, as far as I have studied it, in my opinion, is not a science in the sense of something like physics. You know, in physics, you've got laws of thermodynamics. These are laws. We know how they operate. They operate consistently, I suppose, unless you're talking about in some sort of like quantum context. But set that aside. There are natural laws of hard sciences that in economics we have to take a little bit more of, maybe call it an artistic view. There are so many different elements to what drives the economy that although we can look at these natural forces, see how they operate, see what tendencies they are going to lead toward, it's not the case that it gives anybody really solid prediction powers. And if you've watched some of my previous videos, you know that I kind of rail constantly about how difficult it is to make firm predictions about what rates are going to do tomorrow, what home prices are going to do next year. That said, we know how these natural forces that operate in the economy work generally to influence things. So we can make a somewhat studied, data-based effort to understand not only where we are right now, but where things may or are likely to go. So what we talked about in the first video was how interest rates impact prices. Basically, as rates go up, that's going to reduce the amount of people that can afford to pay certain higher price points. It's just going to reduce essentially what target price points buyers are going to be looking for in their homes. So what I said in the last video is that as rates do rise, which they will and they are, that is going to have a natural tendency, at least to apply pressure on prices to come down. It's not the same thing as saying that they'll go down, but it's saying that as the rates rise, it will put pressure, at least in one way, to push prices down. Now, the other, perhaps more pertinent causal issue is the subject of today's video, and that is housing inventory. So what I've done, I almost thought about calling this video graphs, because I went into the Federal Reserve website, which allows you to generate graphs, custom graphs based on any number of different pieces of economic data. So I just went kind of hog wild. And for this video, we're really taking a close look at housing inventory and home prices. But what I'm going to start with is more of a, let's call it an examination of the baseline. So barring any other discussion of any other variables, what are home prices, generally speaking, going to do? And so what I've done here is I've taken GDP, gross domestic product, and I have overlaid the growth of GDP from 1980 to now. I've overlaid that to the growth in home sale prices over that same time period. Now, if we want to get super pedantic about it, I might need to point out the fact that you've got the right side of the graph here. That's actually what is measuring the red line. That's gross domestic product. Quick side note, I think it's really funny that they seem to be afraid to use the word trillion. I think it's kind of peculiar that they want to talk about thousands of billions. That seems more complicated. But anyway, that's your GDP line. The left-hand side over here, this is corresponding to the blue line, which is home prices. Now, what do you see basically? Home prices go up over time as the economy expands. And this, I think we need to think of as the baseline. As we have essentially an inflation-driven currency system, as our economy expands, you're just going to naturally see home prices expand. Now, this is probably the last thing you would expect to hear from a mortgage person, but one other interesting thing I found, I couldn't really figure out a way to plot a graph because I think it's a little bit more complicated than that. But one thing I thought was really interesting is that home prices, if you track it against inflation, should not be seen as a really great beat the market type of investment. If you adjust for inflation, home prices generally beat inflation by about a percentage point. So that's just an aside. Macro trend, home prices, without any discussion of anything else, are generally going to move up as the economy expands. Let's get into inventory. Now, economics, like I said before, I don't like to think of it as a science because there are so many variables and there's so many ways of observing those variables that it becomes very, very difficult to deal with pure mathematical reality that's predictable and reliable. All we can do is kind of take a stab at it with the limitations of the data and the observation methods that we have. So what I have done here is plotted the same time period, so 1980 to now, for home prices. That's still in the blue line, and it corresponds to the numbers on the left side of the graph. And I'm comparing that to inventory, which in this case, I need to point out, you'll notice that the red line here indicates for inventory, monthly supply of houses in the United States. I think this is really interesting and useful to point out. The way we conceptualize inventory, and one of the standard metrics for measuring housing supply, is actually quite flawed in a sense. What it's really based on is if you take the number of homes that were purchased by buyers last month and compare that number to the amount of active listings for sale, you just kind of divide one into the other, and the number of months that comes out of the other side of that calculation is the monthly supply of homes in the United States. Now, one of the reasons that this is flawed is just because you had X number of buyers last month, it certainly doesn't mean you have X number of buyers this month. So it's a little bit flawed, but it still does give us some perspective that I think is useful. Now, what we see over here during the financial crisis years, you see again inventory spike, and this is more of the effect that you would expect to see. Now, as inventory spiked here, you see prices dropped like a rock. Now, of course, there were all kinds of other things going on, foreclosures, distressed sales, all kinds of bad stuff going on in the economy. So, of course, that was part of that calculation as well. But this, in this case, works more in the classical sense of what you'd expect to see from a supply and demand standpoint. If we shift over to the present, this I thought was very interesting and very illustrative of kind of the root concept we're talking about here. Inventory in the beginning of 2020 was already arguably a little bit lower than maybe the average inventory over this time period, but it dropped like a rock. And what do you see up here with the home prices? There seems to be a very, very direct correlation / causation with inventory going down, pushing those prices up. Now this, all I've done here is I've kind of zoomed in the timeline a little bit. We're looking at just 2019 to present. And again, you can see kind of exactly what you'd expect to see from a classic supply and demand standpoint, what an increase here in inventory did to prices. It seems pretty clear to me that as the inventory ticked up here, that applied a little bit of pressure to push those prices down. And then as inventory dropped, you see prices come up. All right, next up, to give you some historical perspective on this, this is a chart going back to 2016 that's just measuring inventory in a different way, maybe in a more straightforward way, just in terms of active listings. So active listings back in this, let's see, August of 2016, almost 1.6 million homes for sale. If you fast forward to today, you see it's under 600,000. So it seems certainly logical to me that what we're dealing with here as far as prices shooting up, so much over the last year, this is a pretty clear supply and demand issue where the sellers have a product that they can charge way more for than they would if there were more competing properties on the market for sale. All right, I don't think there's a better way for me to do this other than just read a couple of these key points. So this is from a company called Black Knight. They do some incredible analytics of the general housing economy and the economy more broadly as well. But this is what Black Knight had to say about where we're at right now. So entering 2020-21, the number of homes listed for sale was down 32% year over year and had fallen to its lowest level on record. Next up, the hopes that early 2021 would bring much needed inflow of inventory to a market starved for supply have been dashed so far, with new listing volumes coming in well below pre-pandemic levels. In fact, the number of homes listed for sale in January was down 16% from the year prior, while new listings in February were down 21%. Rather than an influx, we now have 125,000 fewer listings than over the first 2 months of 2020 and are trending in the wrong direction, with inventory down 40% year over year. Inventory shortages are most acute among single-family properties, with such listings down 46% from the same time last year. So it is no wonder that in my anecdotal experience, which I understand is, I'm a drop in the bucket versus the bigger trends going on, but just in my own anecdotal experience, I can't name a single buyer that I've closed or worked with over the last 6 months that hasn't had to put multiple offers out there before they land on a contract. I think the record that I know of at this point, I had one particularly unfortunate, unlucky client. I want to say they were up to the 17th or 18th offer, which is just grueling. A couple things I'm going to talk about with relation to what we might expect going forward on the inventory front. Delinquency rate. This is a subject that's a little tough to talk about because we're looking at these cold black and white numbers when really the subject that we're talking about are people that are unable to handle the mortgage payment that they have. So it's a sensitive subject. It's tough to talk about, and it's certainly tough to see the type of numbers that we're looking at here. What we've got, and I think this is useful to know in terms of giving you a sense of scale and proportion. This is that financial crisis era right here. You saw the delinquency rate peaked at over 10%. As a point of comparison, at the beginning of this year, we were hovering around 6%. So maybe not as bad as what we saw during the financial crisis of the 2008 to 2010 era, but still much worse than the average that we see all the way back here to 2000. All right, I'm going to run some math, and I'm going to show you where I'm going with this point on delinquencies. Delinquencies, if you were to study this chart, are up 82% from February of this year versus February of last year. Foreclosure starts are down 87%. Now, this is one of those kind of inside baseball terms, but it actually means exactly what it sounds like. A foreclosure start is literally a foreclosure that has started. So a bank has actually issued the proper legal notifications to get that legal process of foreclosing on a home. They've gotten that done. Now, why are delinquencies up and foreclosures down? Well, that has to do with the law. So effectively, there has been a moratorium on new foreclosures. And that is going to be very impactful on what we see over the next few months. An argument that I'm going to make is that there very likely will be a large influx of foreclosures and sales once restrictions on foreclosures expire in May. So I'm shooting this video on April the 30th. May is right around the corner, and you're going to start to see these restrictions on foreclosures stop. Now, if there's one bright spot, and the reason that I mentioned foreclosures and sales is that one huge difference between the market of today and the market of the financial crisis years is that people have a significant amount of equity today versus what they had back then. And so the argument here is if people are reaching the end of the line with a bank, the bank is going to foreclose. The banks these days are going to be much more accommodating than they were at that time for a lot of different reasons that maybe I'll share for another video. But they're going to have an opportunity to, instead of going through the foreclosure process, the pain of that, they can just list their property as a private sale, work out a deal with their lender to avoid foreclosure. But bottom line, because these delinquencies are up so high, you can expect to see a big influx of new properties on the market that are going to start to change the inventory math and therefore very likely to change the math as it relates to the rapid increase in home prices. All right, so delinquencies, the end of the foreclosure moratoriums. I do believe that that's going to pump a lot of additional listings into the market. The other thing that I think is worth talking about is more theoretical. This is just based on my own kind of musings over this. I have a feeling that there are a lot of people last year that if we did not go through a global pandemic, I think there's a lot of people that would have on their own decided to sell their homes and move. Especially after seeing some of these prices that people are getting when they sell, you're going to see just kind of a natural influx of people that have decided now really is the time. We're far enough away from the worst of COVID, hopefully, that it's time to move on and put the plans in motion. And so I think the combination of these delinquency and kind of distress sale type deals and people that just naturally have maybe put their plans on hold, I think those two elements together are going to put enough inventory in the market to apply more downward pressure on prices. So at this point, to cap up episode 2 in this Chickens Will Come Home to Roost series, you've got now two things, at least in my opinion, that are going to cause prices to come down. You've got rising rates and you've got inventory that seems poised to grow. All right, I hope that you got something out of this very long and potentially dry, somewhat boring video, but I hope that you enjoyed it. Please do like the video, subscribe to my channel. Please share this with anybody out there that may find it useful. Please also comment. I do try to engage with people on there. I'm happy to answer questions. Thanks so much for watching.